RBI dividends are the profits that the Reserve Bank of India, RBI, transfers to the central government every year. The RBI is the Central Bank of India and it performs various functions such as issuing currency, managing foreign exchange reserves, regulating banks and financial institutions, and conducting monetary policy. The RBI earns income from these activities, mainly from the interest it receives on its holdings of government securities, foreign currencies, and gold. The RBI also incurs expenses such as printing currency, paying salaries to its staff, and maintaining its operations. The difference between the income and expenses is the net profit or surplus of the RBI. The RBI follows an accounting year from July to June and it transfers its surplus to the government after deducting its provisions for contingencies and reserves. The amount of surplus transferred is decided by the RBI board in consultation with the government. The RBI Act of 1934 gives the RBI the autonomy to decide how much of its profits to retain and how much to transfer to the government. However, the government can also influence this decision by making requests or suggestions to the RBI. The calculation of RBI dividends is not a simple or transparent process. There are many factors that affect the income and expenses of the RBI, such as exchange rate movements, interest rate changes, inflation, market conditions, and policy decisions. The RBI also has to make provisions for various risks such as currency depreciation, credit default, operational losses, and legal liabilities. The RBI has a complex framework for assessing these risks and making adequate provisions for them. The RBI also has to maintain a certain level of reserves to ensure its financial stability and credibility. The RBI dividends are not a fixed or predictable amount. They vary from year to year depending on the performance of the RBI and the economic conditions. For example, in 2018-19, the RBI transferred 1.76 rupees lakh crore to the government, which was a record high and included 52,637 rupees crore of excess provisions as per the recommendations of a committee headed by former RBI Governor Bimal Jalan. In contrast, in 2019-20, the RBI transferred only 57,128 rupees crore to the government, which was a record low and reflected the impact of the COVID-19 pandemic on the RBI's income and expenses. In the last fiscal year, the Reserve Bank of India, RBI, paid a dividend of 303.1 billion rupees to the government, which was the lowest in a decade. This was due to the impact of the COVID-19 pandemic on the economy and the central bank's balance sheet. The dividend was much lower than the government's initial budget estimate of 896.49 billion rupees for FY. The lower dividend receipt from the RBI added to the fiscal pressure on the government, which had to increase its borrowing and spending to support the recovery. As a result, the fiscal deficit widened to 6.4% of GDP in FY21, which was higher than the revised target of 6.2%. However, for the current fiscal year, the RBI is expected to pay a much higher dividend to the government, thanks to its profits from foreign exchange transactions and revaluation gains. A Bloomberg survey of 9 economists estimated the surplus transfer at 900 billion rupees for FY22, which is almost twice the government's own estimate of 480 billion rupees. Some analysts even projected a dividend of up to 1.65 trillion rupees, which would surpass the RBI's record payout of 1.23 trillion rupees in FY. The higher dividend from the RBI would boost the government's non-tax revenue and help narrow the fiscal gap. The government has set a target of reducing the fiscal deficit to 5.9% of GDP in FY22 and has planned to raise 538.11 billion rupees from RBI dividends. However, with a higher surplus transfer from the RBI, the government could reduce its market borrowing and meet its fiscal goals more easily. What are the challenges and risks of relying on RBI dividends for fiscal consolidation? Fiscal consolidation is the process of reducing the government's fiscal deficit, which is the difference between its revenue and expenditure. Fiscal consolidation can help improve the government's debt sustainability, macroeconomic stability, and growth prospects. One of the sources of revenue for the government is the dividend paid by the Reserve Bank of India, RBI, which is the central bank of the country. The RBI makes an annual payout to the government from the surplus income earned from its operations, such as investments, currency printing and foreign exchange transactions. The RBI dividend can be a significant boost for the government's finances, especially in times of economic slowdown or crisis. For example, in the fiscal year 2018-19, the RBI transferred a record 1.23 trillion rupees to the government, which helped narrow the fiscal deficit to 3.4% of GDP. However, relying on RBI dividends for fiscal consolidation also poses some challenges and risks. Some of these are: the RBI dividend is not a stable or predictable source of revenue for the government. It depends on various factors, such as the RBI's income, expenditure, balance sheet size, contingency reserves and accounting policies. These factors can vary from year to year, depending on the economic and financial conditions, market movements and policy decisions. For example, in the fiscal year 2019-20, the RBI dividend fell to 303.1 billion rupees, which was the lowest in a decade. The RBI dividend is not a free lunch for the government. It comes at a cost of reducing the RBI's own capital and reserves, which are essential for maintaining its credibility, independence and effectiveness as a central bank. The RBI needs adequate capital and reserves to perform its functions of monetary policy, financial stability, currency management and lender of last resort. If the RBI's capital and reserves are depleted below a certain level, it may compromise its ability to deal with shocks and crises in the future. The RBI dividend is not a substitute for structural reforms and expenditure rationalization by the government. The government cannot rely on RBI dividends to finance its spending needs indefinitely, without addressing the underlying issues of revenue mobilization, subsidy management, divestment targets and quality of expenditure. The government needs to pursue a credible and sustainable fiscal consolidation path that balances growth and stability objectives. Therefore, while RBI dividends can provide some relief to the government's fiscal situation in the short term, they are not a long-term solution for fiscal consolidation. The government should use them prudently and sparingly, and focus on improving its own fiscal discipline and efficiency.